In order to understand the market action for the first part of 2023, I think it's important to understand where we came from. In 2022, the market declined about 22% as investors were afraid of inflation. Inflation was rising very quickly and hit levels we haven't seen in more than 30 years. And as that declined and the Fed started raising rates in order to combat inflation, there was a rising expectation that a recession was coming. By the time we get to the fourth quarter of 2022, people became overly pessimistic, and as new data from various sources on inflation showed that maybe that battle was being won, investors breathed a sigh of relief and new buyers came into the market.
Some of the reasons for the pessimism that we experienced at the beginning of the year was that the Federal Reserve went on a very fast monetary tightening campaign. We raised interest rates from 0 to 5% within a year, a very fast speed. Historically, when you go back and look at what usually happens after such fast tightening cycles, you tend to have a recession.
2023, markets have been pretty volatile. The main focus point for investors is that earnings are down. 2022 earnings were falling pretty aggressively, and stocks followed them down. 2023, stocks were down in the first half. It appeared that the Fed was going to stop hiking rates to slow things down, and earnings came in flat after the second quarter, and we're in a hold pattern coming into the third quarter, and stocks have rebounded a touch. You know, the federal government has spent nearly $6 trillion to rescue us or save us from COVID, and it appears that has helped the economy and pushed out the recession.
The positives that investors should focus on now is the fact that interest rates are higher. We haven't been in this interest rate environment since pre-financial crisis. And so many retirees were forced to have a very large allocation to equities or real estate or private equity to meet their return requirements because fixed income market or cash was paying them nothing. Now we're in an environment of higher rates across the board so that we're able to build nice fixed income portfolios for them to meet their income needs without having to take excessive risks.
So as we look ahead to the fourth quarter, what do we think is going to happen there? Seasonality for the stock market is actually very strong in the fourth quarter, and most investors might look at that with a strange look. Seasonality, why do we care about that? And it's absolutely not a main driver of how we manage portfolios, but when we look at various contexts, do we see other positives? If we see other positives and seasonality is positive, then that's sort of just an incremental piece of the puzzle that helps us make decisions. While we think a recession is certainly possible, that doesn't mean that every stock should be sold. It doesn't mean that every area of the market should be avoided. It means we have to look really closely at where we want to put client capital.